for the normal length of a shutdown, it's not materially affecting any of my macroeconomic assessments. That's not to say that it doesn't affect individual people's lives. That kind of first month of a shutdown is not a huge macro scale thing. Now, as we enter the second month and we start to get into news about like food stamp programs and stuff running dry, that's where the game changes. We don't, like you said, this could be the longest one. We don't have a lot of precedent for how a shutdown could impact things after we get into this, like, when you start to get kind of deep into month two.
It's one thing when the lights go out in a single household. It's quite another when they begin to flicker across an entire nation's economy. Right now, the 2025 United States federal government shutdown isn't just political theater. It may be the opening of a structural shift in how the U.S. economy functions. The question we must ask ourselves is, when does a shutdown stop being a hustle of headlines and become a macroeconomic fault line? In today's video, we bring you Lyn Alden, an analyst whose long-game perspective far exceeds the typical cycle chatter, to break down exactly when and how a government shutdown transitions from headlines to hard data, and why that matters for investors like you and me. Lyn's core thesis is this: for the first month or so of the shutdown, the big economic aggregate numbers may not move much, but once you cross into month two and start seeing strain on social safety nets, food stamp programs, and delayed government services, that's when the dynamics change. And because we don't have a strong precedent for extended shutdowns, this one could expose cracks that run deeper than any prior one. So if you're here to understand not just what is happening, but why it matters for real money, real portfolios, and the next leg in macro markets, stay right here. Hit like, subscribe, and let's get into the analysis. Thanks, and enjoy the video.
And I've been focusing on fiscal now for quite a while. It's kind of one of the key things that I think has, in many cases, blindsided a lot of macro, just because in this whole kind of 5 to 6 year period, it's played a much larger role than it normally does, especially outside of recessions, in any sort of like investor's lifetime, for the most part, at least in the United States and many other developed countries. And so it continues to be an environment that is just challenging for a lot of people, myself included, obviously, but being on the right side of fiscal has been helpful. Basically, if we go back kind of earlier this year, my view was that Doge would be ineffective at any sort of like macro scale cuts. But the tariffs were somewhat of a wild card because, well, I don't think they can stop the train. I don't think they can like permanently and kind of sustainably reduce fiscal spending by a huge amount. They can slow the train, and that's largely because one of the key kind of defenses against reducing the deficit is that Congress is very polarized, and emergency powers to use executive orders to do tariffs is basically a unilateral tax increase that bypasses that polarized state. Now, as you pointed out, the Supreme Court is going to weigh in on that likely in November. Last I checked. So far, 2 levels of courts have kind of ruled against Trump on that. But those, I mean, I'm not a legal expert. The challenge, of course, is that those were, if you look at the makeup of those courts, they were more Democratic-leaning courts. Supreme Court's obviously more Republican-leaning. But he has put out a number of posts that kind of directly contradict his rationale for emergency use powers. He'll cite domestic issues in Brazil for why they need tariffs, or he'll cite commercial in Canada for why they need tariffs, and that just gives fodder to the other side of that law case. Other than looking at some of the betting markets, I don't have a strong view on how that case is going to go. Of course, before then, we potentially have the ongoing supposed de-escalation in this recent tariff flare-up between the U.S. and China. It's still not fully clear whether that's going to go through or not. In general, that is one of the key speed breaks. And it's showing up, for example, in if you look at ISM PMI, like manufacturing and services PMIs, you'll see that they both have pretty muted activity, but the prices paid segments of those are pretty high. And normally you only get spikes in the prices paid component when you also have a pretty rapid period of expansion. So that combination of lower activity and higher prices paid is this kind of stagflationary effect from tariffs. Now, in context, we're talking annualized a few $100 billion per year, potentially higher if we get more escalation, which would not really be my base case. So that's spread across a pretty large economy, and that eats into something approximating a $2 trillion deficit, which is not immaterial, but it's not like a game changer. So I do think that while Doge was mostly a nothing burger from a macro standpoint, tariffs are more than a nothing burger. They are a kind of one of the top few things that I follow. So we certainly have a lot of news ahead as that goes. So I think that they do slow the train. They just don't stop the train. Key reason why that's still in play is that if you look at PMIs, you would expect, for example, just looking at them in isolation, if you just say, okay, PMIs are doing this, overall economic activity is slowing to this degree, would stock market be where it is? Would gold have soared as high as it is? Would Bitcoin be 100,000? Would we have kind of had this long of an inverted yield curve without a Ember-defined recession? Basically, the fiscal component is kind of weighing on a lot of that. And I had some discussions or debates with Andy Constant over the past year, and it is true that like we're not accelerating the train right now. If anything, we're mildly decelerating what is still a very fast train. Especially in a non-recession environment, these are still very large deficits. And so you have this kind of background stimulatory component that does fluctuate. And that's why I don't just stop writing reports and go to the beach for a year, right? I'm still kind of mapping out the rate of change these things happen, the news events that happens, little booms and busts that happen along the way. So there still are opportunities, there still are uncertainties along the way, but that just kind of underneath this whole sine wave that we normally invest in, there's this higher floor. And so right now, yeah, we're more compressed than we were last year. So basically, we had, of course, the huge COVID stimulus, and we had in 2022 was kind of the contraction from all of that, as well as higher prices. 2023 and 2024 were this kind of reaccelerating period in a more mild sense than, of course, the boom. And 2025 has been this decelerating period, but from that high level. And I don't think that will just like persistently decelerate back to what we saw pre-COVID. And then, of course, the other factor is that while nominal GDP is not as explosive as was before, it still is often surprised to the upside, especially compared to a lot of what the bears were expecting. And one of the things I kind of point out with fiscal deficits is that they directly fuel nominal GDP. Of course, they have all the other offsets that can, detract from nominal GDP growth. And so when you look at, say, deficits as a percentage of GDP, or even overall federal debt as a percentage of GDP, I don't expect that to grow very rapidly because I think that both nominal deficits and then to some extent nominal GDP will be generally more elevated than average from what we're used to, say, throughout the 2010s, with the caveat that we still have this, this general like sine wave type activity along the way.
Lyn begins by pointing out that the macro numbers we invest in, GDP growth, credit flows, corporate earnings, don't immediately register a single month of shutdown. That flat period can lull you into a false sense of normalcy. But the real risk begins when shutdown drags into month 2 and beyond. Programs such as SNAP, food stamps, delayed regulatory filings, and labor bottlenecks begin to impact lower income segments, which don't register in the aggregate quickly, yet carry real consequences. In other words, if you're only watching headline growth or inflation for the first 4 weeks, you might miss the structural weakening building underneath. This segues into Lyn's broader point on why fiscal and political stress matter more now than they might have in past cycles. From there, Lyn pivots to the other side of the macro ledger, the hidden domains of liquidity, debt servicing, and central bank balance sheets. She argues that one of the key telltales of systemic stress is not necessarily in the unemployment rate or consumer spending line, but in how government financing, reserve balances, and central bank operations respond when the shutdown begins to bleed into those areas. We'll pick that up in the next clip, where she walks us through what escalation beyond month 1 looks like and why it may force policymakers into unfamiliar territory.
I wrote about this about a month ago, right when it was about to start in one of my research reports. And my view at the time was for the normal length of a shutdown, it's not materially affecting any of my macroeconomic assessments. That's not to say that it doesn't affect individual people's lives. So I don't want to come across as like insensitive when I say that, but just from the big numbers I look at, the things I'm going to invest in, that kind of first month of a shutdown is not a huge macro scale thing. And now as we enter the second month and we start to get into news about like food stamp programs and stuff running dry, that's where the game changes. We don't, like you said, this could be the longest one. We don't have a lot of precedent for how a shutdown could impact things after we get into this, like, when you start to get kind of deep into month two. I still would put probably the social aspects higher than the economic aspects in the sense that, when you kind of impact that lower income segment, it doesn't necessarily show up super quickly in some of these big numbers right away because, as many people know, like if you look at the top 1, the top 10, the top 30% of people in terms of income or wealth, they do a really big lion's share of the spending. So when you impact that 20 to 30%, it doesn't necessarily impact all the big macro things right away. But it does, of course, contribute to social tensions because it's still a pretty big percentage of the population itself. And so I still wouldn't put this next 2 to 4 weeks as super macro impactful, other than that it's more socially impactful, and that is a part of macro these days. And then there are many other kind of indirect things. I mean, there are SEC things that are delayed because of this. Arguably, flights are impacted by this because we already have a very tight air traffic control system in terms of labor. And so it's like you don't really have a lot of like to work from there. So around the margins, impactful, but just it's not as quite as big as some of the other things I'm watching. But the longer it goes on, the more it actually does become material.
How are you thinking about the fact that central bank Fed balance sheet is relevant again, and what are some of the insights you're getting from there?
So I think X is going to be fun in the coming weeks and months, because it'll be a lot to talk about, a lot to unpack. I think. For context, back in 2019, it was Twitter at the time, we had it was the September 2019 repo spike, and that was one of those like little economic crises that most people didn't have to worry about, but of course anyone in macro trading on FinTwit at the time was freaking out about. And you had kind of competing narratives at the time. And the reason that's relevant is because this is somewhat similar to that, just less compressed. So back then you had some people, you had kind of the bears saying, oh, something broke in the banking system. Banks don't trust each other. This is going to portend something large. Now, ironically, months later, we did get COVID, but this was all before then. So it was like some major bank might have failed or this, and then the other side was kind of saying, this is just a technical issue. It's not a big deal. It's no, it's not too much debt. It's not any of that. And there was a camp that was like Luke Gromen, myself, and some others saying it's not really either of those two things. It's basically there's a liquidity shortage, but it's not ultimately a repo problem. It's basically a T-bill oversupply problem relative to other types of liquidity that were available. And so although the Fed was putting out the fire by doing repo activities, that they were very likely going to go to start permanently buying treasuries. And a couple of weeks later, in like mid-October, they did exactly that. So this was all pre-COVID, before all that hyper stimulus. They ended their quantitative tightening. They went back to kind of persistent balance sheet increases. Now they didn't want to call it QE because one, it was not for the purpose of economic stimulation. And two, they were not buying longer end of the curve. They were buying T-bills. And it was basically to just keep banks liquid so that they could meet all of their liquidity, kind of requirements while continuing to lend. And so it was more like anti-deflationary than it was stimulatory, and it kind of putting out those fires. Now, of course, then we got all the COVID stimulus, and then we got all of the kind of balance sheet reduction after the fact. The scarce and ample reserve regime is interesting because there was a Fed paper a few years ago that argued that I think it said 8 to 10% is the transition point between scarce and ample, and 12 to 13 goes from ample up to abundant, of bank cash as a share of assets. So there's a couple ways they measure. Sometimes they measure balance sheet relative to GDP. Other times they measure bank cash as a percentage of bank total assets. And I believe this paper referred to the latter, which was bank cash as a percentage of bank assets. And if you look at the repo spike, that got down to that kind of transition point between ample and scarce. Whereas this time, the strains are kind of starting a little higher. They're starting at that 12 to 13% range, which is that boundary point between ample and abundant, which basically, it's interesting. It's kind of like the pain point is running a little bit higher this time. Although because the Fed has purposely slowed down their balance sheet growth, they've kind of ahead of time tried to avoid the repo spike scenario. So they have these facilities standing and ready So they're already in use, at least on some days. And then two, they're kind of trying to land that plane slowly rather than just kind of hit it, bounce off, and have to start going up quickly again, like they kind of did in the repo spike of 2019. So basically, we're getting increasing signs of liquidity strain. It used to happen a couple times at the end of a quarter for window dressing. Now it's happening mid-quarter, which is why this time's different than prior months. The Fed is likely going to end quantitative tightening soon. It could be at this upcoming meeting. We don't know yet, but they have some flexibility for when they do it, but it's likely going to be somewhat soon. And then in the coming months, they're likely to go back to a period of mild balance sheet increases. Now, probably on Twitter X, you'll see people saying, "Oh, like we're going to hyperinflate," or "Oh,
QE is here, QE infinity."
yeah, banks are failing, or this is happening. I'm in the camp that it'll be a relatively slow balance sheet increase. Now, maybe down the line we have another crisis and it ramps up again, but for this particular phase, I think we're exiting a period of slow balance sheet reduction, perhaps entering a period of flatness for a little while, and then most likely entering a period of gradual growth.
What if I told you there's a way to grow your crypto tax advantaged and receive a $100 bonus just for getting started? Savvy Finance has teamed up with iTrust Capital, the #1 platform that allows you to buy and hold crypto within a self-directed IRA or their brand new Premium Custody Account, PCA. That means you can trade over 80 top cryptocurrencies, Bitcoin, Ethereum, XRP, Solana, and even trending tokens, as well as gold and silver, while keeping your gains protected from heavy tax bills. Here's what makes iTrust Capital stand out. Tax advantages. Legally defer or even eliminate capital gains taxes on your crypto. 24/7 trading access. Buy and sell crypto, gold, and silver anytime, anywhere. Low-cost structure. Only 1% per transaction, with no monthly or hidden fees. Security first. Institutional-grade custody partners keep your assets safe. Simplicity. Sign up in minutes. Roll over funds from old employer plans, or even transfer crypto directly with in-kind transfers, something few providers offer. Instead of losing thousands to the IRS, every dollar stays compounding in your account, building the future you actually want, all while holding the assets you believe in most. And here's the best part. When you sign up and fund a new iTrust Capital IRA or PCA, use promo code SAVVY9, and you'll claim your exclusive $100 funding bonus. That's SAVVY9 for an instant $100 bonus, exclusively for savvy investors like you. So if you're serious about growing long-term crypto wealth, this is the smarter, safer, and more rewarding way to do it. Hit the link in the description, sign up in minutes, and put your crypto in a structure built for growth. What this all means for you and me as investors is pretty radical. If we're right, and this shutdown evolves into a macro trigger, we're looking not just at a temporary dip, but a strategic reset in economic assumptions, growth expectations, fiscal deficits, central bank coordination, even currency valuations. For crypto holders and watchers especially, this is significant. Assets like Bitcoin and other non-sovereign stores of value may come into focus as alternative hedges when normal policy tools are stretched. Lyn's analysis suggests we're entering a phase where fiscal dominance is back in play and conventional buffers are thinner than they appear. If you're thinking, this could be important, but should I move? The answer isn't an immediate trade, it's a preparedness mindset. Understand the stress points in the system, watch the second-order effects, and position accordingly. And drop a comment below. What do you believe is the first major macro symptom that signals the shutdown has moved from manageable to critical? If you found this framing helpful, smash that like button, subscribe for deep dive macro updates every week. Thanks for watching, and see you in the next one.